Ladies and gentlemen, good day and welcome to the Q2 and H1 FY24 earnings conference call of Yasho Industries Limited, organized by Orient Capital. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Bhavya Shah from Orient Capital. Thank you, and over to you, sir.
Good afternoon, everyone. Thanks for connecting to Yasho Industries Q2 and H1 FY24 business Concall. Today we have with us with the management, Mr. Parag Javeri, Managing Director and CEO, Mr. Ayush Javeri, Full-Time Director, and Mr. Deepak Kaku, CFO. Before we proceed with the call, I would like to give a small disclaimer that the conference call may contain some forward-looking statements which are based on the beliefs, opinion, and expectation of the company has on date. A detailed disclaimer has been given in the company's investor presentation. I hope everyone had a chance to go through it, which has been uploaded on Stock Exchange yesterday. I would now like to hand over the call to the management. Over to you, sir.
Good afternoon, friends. On behalf of Yasho Industries Limited, I would like to extend a warm welcome to all of you who have joined us for this result call. We appreciate your time and interest in our company's performance. I hope that everyone had an opportunity to go through the financial results and investor presentation which has been uploaded on Stock Exchange. As we delve into the financial and operational performance of the preceding 6 months, it's crucial to highlight that our steadfast dedication remains firmly centered on delivering maximum value to our stakeholders. In first half of FY24, we find ourselves navigating through a global economic landscape marked by challenging macroeconomic conditions, high inventory cost, and significant price fluctuations. While Yasho's volume has managed to remain steady, we have experienced a 21% decrease in our sales value due to fall in selling price. However, our focused effort on enhancing the product mix and implementing dynamic pricing strategy have allowed us to navigate this turbulent time effectively. We have strategically positioned ourselves to ensure a more resilient performance in the forthcoming quarter, with the goal of safeguarding the interests of our valued stakeholders. Also, we expect from Q4 the scenario will improve and we will be able to capitalize on the same. Coming on to operational performance, Yasho Industries operates within the 2 core categories. In first category, which include the consumer chemicals like food, feed, aroma chemicals, personal chemicals, contribute about 70% of the revenue, while the second category encompass industrial chemicals such as rubber, lubricant, polyurethane, epoxy resins, which account for substantial 83% of our total revenue, demonstrating resilience even in the face of subdued demand for the key products across various geographical locations. Furthermore, our exports have encountered a year-on-year decline from 69% to 62% of our total sales, primarily attributed to the ongoing geopolitical situation and slowdown in Europe market in particular. Turning our attention to capital expenditure initiative, the greenfield project at Pakhajan, designed to more than double our capacity, is proceeding according to plan and is expected to commence production in early FY25. We are scheduled to conduct a trial run post-Diwali. This project holds a pivotal role in our growth strategy, and we hold strong confidence in its potential to create substantial value for our stakeholders. In addition to this, we have incorporated a new wholly owned subsidiary in United States, making a significant step in our expansion and growth strategy. This new subsidiary is poised to play a crucial role in our business operations in the United States. Despite facing short-term challenges, our long-term strategy remains steadfastly unchanged, with an unwavering focus on expanding manufacturing capacities, diversifying our product portfolio, and extending our market reach. In conclusion, we harbor optimism for our future trajectory of our business and are enthusiastic about the prospect of Yasho Industries Limited. Our commitment to creating lasting value for our stakeholders in conjunction with the prudent financial management and strategic initiative will be pivotal in sustaining our growth in the forthcoming years. So that's it from my side. We are opening the floor for question answer. Thank you very much.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Manan Shah from Moneybee Investment Advisors. Please go ahead.
Yeah, hi. Thanks for the opportunity. You mentioned about price correction in our products. So across our 5 categories that we have, so which category has seen the price drops? If you can talk a little bit about that.
That's mainly to the consumer care products and some of the product category into the specialty range.
Okay, so the lubricant additives and the rubber chemicals have not seen any pricing correction?
Not significant. There is a slight price correction, but not significant as compared to the consumer care and some of the products from specialty.
Okay, and the high cost inventory also pertains to the those segments only, right? Not to the lubricant and the rubber chemicals.
Oh.
Okay. Can you give the contribution in the industrial side out of the 3 categories, rubber, lubricants, and specialty? What is the revenue contribution of these individual categories?
I think we don't want to give that insight of thing, but the major contribution comes from rubber and lubricant segment, at least in first half, I can say that.
So we used to give this bifurcation, I believe, till May, till FY22, where I think last when we had disclosed, lubricants was contributing roughly 15% of the revenue. So has this improved as on date, or it continues to be at those levels?
It has improved substantially.
Okay. So this improvement has, I mean, we haven't, so the capacities that we have, so there has been any improvement in the capacities, or the capacities were fungible which led to this improvement?
Well, last year we have debottlenecking and some addition. Our capacity has increased to 12,500 metric ton. And we are confident to achieve at least 90% utilization in this year, despite this current challenges. So we have been able to capture more market share, or able to get a lot of new customers on our active customer base. So that is helping us to grow the segment.
Okay. And my last question was, so we've given about the product A, B, C, and D, which we plan to foray into post the capacity expansion. So these are not existing products, right? These are totally new products apart from the product T where we are having around 35 crore sales.
Yeah, so yeah, those are new products, and we have identified a number of customers who is interested in this, but they all will come on board once we start the production.
Okay, and this will be sold under our brand Yaluk, or are these a contract manufacturing sort of arrangements?
There is nothing contract manufacturing. It's all Yasho direct B2B sales.
Okay. Thank you. I'll get back in the queue.
Thanks, Manoj.
Thank you. Ladies and gentlemen, to ask a question, you may please press star and 1. The next question is from the line of Aman Tadani from Solidarity Investment Managers. Please go ahead.
Hello. Thank you for taking my question. Sir, my first question is, as we understand that the current performance is impacted due to lower realizations and high-cost inventory lying in books. So assuming that we are not sitting on high-cost inventories, what would be the revenue per quarter that we would do at optimum capacity utilization? And what's the normalized peak gross profit and EBITDA profit in absolute terms that we would do then?
Peak revenue, what we expect is in the range of about 700 to 750 crores from Vapi operations, with a capacity of 12,500 metric ton maximum what we can achieve from Vapi. The Pakhajan will start contributing to the revenue post 25, means somewhere in Q1 25 we should start getting a revenue coming out from the Pakhajan part of it. And that revenue we expect in the range of about 500 to 600 crore, depending on the prices at that time.
Okay. And sir, on the profitability from the Vapi operations, like on 700 or 750 crores, what's the absolute gross profit and EBITDA profit that we can do? Since the margin is a bit meaningless to look as due to the fluctuation in raw materials. So I just wanted to know that.
Before this, last year we were having a gross margin of about 38 to 40% gross margin. Now the gross margin has dropped to about 33-34%. We hope that in a normalized year we should be back to that 38 to 40% margin from Vapi, and EBITDA of about 18-19%.
Okay, sir. So my second question is, what is the quantum of high-cost inventory that we are carrying, and how long will these inventory last for before we come to normalized margins?
Well, what we had a major inventory has been utilized of high cost, except one or two products which we are still carrying. But besides that, everything is normalized now. Yeah, I can say that as of today.
So can we assume that from Q3 onwards we'll be back to 38 to 40% gross margins and around 18% EBITDA margins?
No. The reason answer no is that because there is still challenges in the market. Still there is a subdued demand. In 22 and 23 there was more of a seller's market. Now it's become buyer's market. So to hold on the business, we have to give some discount. What we lost about 2% EBITDA margins from compared to last year, that was mainly due to the giving partially due to the high cost inventory and partially due to the discount what we need to offer in the market to sell your product. Okay, for us the more priority is to run the plant at optimum capacity rather than sitting on inventory or not to sell the product.
Okay. And sir, my next question is, sir, that we have got some softer commitments from customers for the phase 1 capacity at Pakhajan. But the Vapi facility has been operating at 75% capacity utilization approximately. So my question is, why aren't these customers able to fill up the Vapi capacity?
Well, Vapi capacity as of today run about 85% or capacity. We have, as I said, that the volume has not impacted at all. volume impacted only in the case of consumer care, and one-off for two products only into the specialty segment. Rest of the segment we have grown, volume has been grown there. And the question of capacity, when this new big customer comes on board, if you change the location of the product, you need to revalidate altogether. So they are not in hurry. They say, let's come with the plant, so they don't need to revalidate it twice. It's an expensive affair. Exercise one has to do that.
Understood, sir. And sir, my last question is, basis the current environment, how are we looking at the ramp up in our phase one capacities?
Well, we always said that in 25 we are going to cover about 50% of our utilization, and that is going to happen gradually. So we may happen in the first quarter 15 to 30%. I don't know. I can't give any. Everything depends on how quickly the customer gives approval, audit the facility, and we start the ramping up. But as an overall year, we are expecting about 50% utilization in a first year. That is FY25.
Okay. That is it from my side. I'll join back in the queue. Thank you.
Thank you.
Thank you. The next question is from the line of Gunit Singh from Counter Cyclical PMS. Please go ahead.
Hi, sir. Thank you for this opportunity. So can you give a brief overview of the kind of products that will be produced from the new capacity? Are they completely new products, or is it something that we already are into?
There are two new products. Rest of all products what we are producing today in Vapi, that will be the capacity expanding there.
All right. And I mean, what kind of revenues are we expecting from this new plant in FY25? What kind of revenues can we expect, and what kind of margins can we expect?
Well, we expect it to utilize about 50%, and we do expect some little higher, better profitability in terms of EBITDA margins from a new facility. So currently, we are running at about 17-18%. We should cross 20% if all goes well.
All right. And sir, considering that the high-cost inventory has been utilized, and what kind of margins do we expect for H2 FY24? I mean, can we go back to 17-18%, or I mean, do we expect?
We are already at 17% margin. Okay, so we dropped by about 2 points, and I cannot assure that it will reach back to the 19 again, but definitely we work hard towards to achieve that number. Looking at current situation, we will be able to improve marginally from 17% what we had in this quarter.
All right. That's all from my side. Thank you.
Thank you.
Thank you. We have the next question from the line of Vinay Mehra, an investor. Please go ahead.
Yes. Thanks for the opportunity, sir, and good evening. So my first question is with regards to the product mix. So what are we looking at this new facility at Pakistan? And also, when would the trial run would start at this facility?
I have already said that the post-Diwali the trial run will start. The products are coming from the industrial segment.
Okay. And my next question would be with regards to, I mean, could you throw some light on why we incorporated a new subsidiary in United States?
Well, to tap the more customers who are not willing to import directly. And if we go direct to the customers, we have assurance of the long-term business. What we have seen from our Europe transaction, and to reach out to the more end users rather than depend on the distributors who can sell the product under their brand name. So customers are not even aware if the product comes from home. So it's always better as a long-term goal that you sell directly. You also have a definitely little higher margin than what you are selling to a distributor. So it will be a two-pronged strategy to reach out to the more customer base and to increase the margins.
Okay. Okay, got it, sir. Thanks for this opportunity and best luck. Thank you.
Thank you. The next question is from the line of Anupam Agarwal from Lucky Investment Managers. Please go ahead.
Thank you for the opportunity and good afternoon. So my first question is on your balance sheet. Our debt has increased. That.
Your echo.
Hello, can you hear me now?
Speak slowly. If I can hear properly, I can give you answer that, Anupam, because there is a lot of echo. You speak.
So my question is on your balance sheet. Our debt has increased massively from 275, 300 to now 475 crores. What do you think our peak debt will be going forward this year, next year? And what is our debt plan going forward?
Well, we have anticipated peak debt of over 500 CR. That's a peak debt we anticipate. And we did discuss that in our previous calls also. So that's a peak debt what we anticipate. And our repayment will start of this in 25-26, FY26 repayment will start.
Repayment will be to the tune of 100-200 crores or lesser than that?
Sorry?
Repayment will be to the tune of 50-80 crores or
much less. Only 20%
lesser than that.
Total debt. So total new debt is 230 crores. Of that, only 7% will be repaid.
Okay. Understood. So second question, our mix has improved, like you mentioned in the presentation as well, more towards the industrial segment, which is a higher margin business. But on the reported terms, our margins have fallen on gross margin and EBITDA margin. That does not really add up despite our mix improving to a better margin. So if you can just maybe give some more color there.
Well, we are always said repeatedly that the consumer side don't give you enough margin. That is one of the reasons. Second thing, for lower margin was high cost old inventory. That is inventory carried forward from 23. Two has impacted. And so that was a major reason for the drop in margin.
So the 200 bits drop in margin, how much would that attribute to high cost inventory?
Over 30 to 35%.
Okay. Understood. I'll come back in the queue, sir.
Thank you.
Thank you. The next question is from the line of Manjeet Waria from Solidarity Investment Managers. Please go ahead.
Hi, sir. Am I audible?
Yes.
Okay. Sir, thank you for taking my question. Sir, you mentioned a while back that, what has happened right now is it's become a buyer's market versus a seller market earlier. So I wanted to understand what has changed. Has the demand gone down or, has excess supply come into the system?
Demand has gone down to some extent in certain categories.
Okay. So in terms of competition, the number of competitors haven't increased. It's just the demand is lower, so the existing competition is pricing lower. Is that the right way to understand this?
Yes.
Okay. And sir, this is observed in all your segments or any specific segment?
I did say that it is observed only to the consumer care and the one of the two products into the specialty category.
So, sir, I'm a bit confused. I'm linking back to a previous question. So if it's not really visible in our industrial side, which is higher margin products, right? And the mix of those products has gone up because demand there is more stable. Demand has not gone down. Right? Then why are our gross margins actually still compressing? Is it purely the raw material thing or am I missing?
It is a purely raw material thing. High cost inventory, number one. Number two, also the consumer care as margin is further reduced. Hello. Hello.
The current participant seems to have dropped from the queue, sir. Okay. We will move to the next question, which is from the line of Manan Shah from Moneybee Investment Advisors. Before you ask your question, sir, I would like to announce that anyone who needs to ask a question may please press star and 1.
Yeah, hi. Thanks for the follow-up. My question was regarding your earlier comment where you mentioned that the Vapi facility, which has a 12,500 metric ton capacity, can generate a revenue of around 700 to 750 crores, while the Pakhajan facility, which is a 17,500 metric ton capacity, can generate around 500 to 600 crores of revenue. So, I mean, would that infers that the realizations per ton for the upcoming facility is on the lower side than the existing per ton realizations? Because since it's a higher capacity, however, the revenue that it can generate is on the lower side than the existing setup.
Well, products are different. What we're going to produce in Pakhajan compared to Vapi, number one. Pakhajan has a more voluminous product, kind of a category of bulk volume, while Vapi is more niche, which is a low volume product, low volume, relatively high price compared to the Pakhajan. So that's why both are different. Number two, we work on a percentage rather than a per ton category. So we look at about 38 to 42% gross margin, or somewhere 30 to 50% gross margin. So average margin comes to us about 40%. So that is the way how we place ourselves, depending on the volume and the segment that we work. We have a certain benchmark internal. So at that margin only we work on the business.
Okay,
so
understood.
You cannot correlate between Pakhajan and Vapi with the tonnage.
Okay, understood. And my second question was on these new products that we've mentioned. We've mentioned our target revenue, which we aim to achieve over the next few years for these products. So, what percent of the market of these products are we trying to capture when we say that we'll achieve, say, 3,000 crores sort of revenue for product A and B, 500 crores? So what percent of the market are we targeting? And what rate is the market for these products growing, and what is the competitive landscape for these products?
I don't know, Manan, why you're confusing yourself. When we say the market potential, we didn't say that we will achieve that sale. When we talk about product ABC, we talk about the market potential. We never talk about the Yashos can reach that.
Okay, understood.
So let's clear that part of it. So what was the second question?
Yeah, so we've mentioned that the market potential for product A and B is, say, 3,000 crores, for C is 2,000 crores, and D is around 500 crores. So what part of, I mean, how much can we capture out of this market from these products?
Well, I will never like to cross more than 25% of the market, 20-25% market share. That sense, that one should be much more happy with that. Otherwise, there is a lot of big players who can come and hurt you badly. So generally, I never try to grow beyond that segment. And nowadays in global position, with the supply chain disturbance, people have learned that you can't rely on one supplier. You need to have multiple supply chain, okay, to ensure that any disturbance happens can be taken care.
Right. So what is the competitive landscape for these products? Are there 2-3 suppliers only currently in the market, or are there more? And what rate are these products growing at?
It's all we have 150 products. I cannot give you the competitive supply chain of.
I'm talking about these 4 products, which we are looking to launch.
Obviously, there is a competition, but the market is also growing at the rate of 3 to 5% as a demand point of view, and that is helping us to grow the market. Number 2, the Make in India, organized labs and so the Make in India concept is helping us to grow the business. Right? So one cannot exactly quantify. What we are aiming is also 500 crores of that total revenue of 500 crores. Our total revenue in phase 1 is not more than 500 to 600 crores. So of that means we are only targeting 10% of the business.
Right. Understood. Sure, I'll get back in the queue.
Thank you.
Thank you. Participants, to ask a question, you may please press star and 1. The next question is from the line of Ranjit Zaveri, an individual investor. Please go ahead.
Hello. Thank you for taking my question. Sir, could you provide an update on the demand trends in our key end user industries across Europe and the USA? And also, I'm particularly interested in understanding how the demand is shaping up over there.
Well, as long as Ranjit, demand in Europe is concerned, it's still under question mark. We have seen some spark in inquiries and some orders for delivery only in 24, not this year. So that shows that somewhere the pipeline is getting empty and the people are willing to take some stock. While in USA the demand is, I can use the word very good for all the segments. And, they are reasonably doing good. As we know, the US market is growing very well. So US is a robust demand, but Europe is a challenge. To compensate Europe, we have expanded our footprint into the Asian market and the Middle East market, and also try to expand into the Latin American market.
That was helpful. All the best.
Thank you.
Thank you. Ladies and gentlemen, if you wish to ask a question, you may please press star and 1 at this time. As we have no further questions, I would now like to hand the conference over to the management for closing comments. Over to you, sir.
Thank you, everyone. I would like to thank everyone for taking time out and joining on the call today. I hope we have been able to respond to your queries adequately. We look forward to your continued support as we navigate the road ahead together. Wishing you and your loved ones a joyful and prosperous Diwali in advance. Thank you.
Thank you. On behalf of Yasho Industries Limited, that concludes this conference. Thank you all for joining us. You may now disconnect your lines.
Thank you.